Welcome to vTalkInsight, Risk Sentiment Daily for April 3rd, 2026. Oil prices are surging again. Middle East tensions are back on the front page, and yet U.S. equities are proving more resilient than the headlines suggest. Let us unpack how that clash between an energy shock and solid earnings is leaving risk sentiment volatile and defensively positioned across portfolios. Across assets, today's tone is clearly defensive, even though the closing index levels underplay it. Equities saw meaningful intraday declines, with the S&P 500 and Nasdaq down around 1.5% to 2% at points, as renewed geopolitical headlines hit just after the strongest two-day rally since last May. Volatility has picked up again, with swings amplified by alternating escalation and de-escalation signals out of the Middle East, and the volatility index holding in the low to mid-20s, which is still a stress regime rather than a calm one. Trading patterns point to a market that wants to own risk for short windows, then cut it back quickly. Gains early in the week are giving way to de-risking as weekends approach, because investors do not want to be caught in illiquid hours if headlines on Iran or the Strait of Hormuz turn worse. That caution shows up in pronounced sector rotation, with airlines and consumer discretionary names under pressure from higher fuel costs and weaker travel, while energy, staples, and utilities are taking over market leadership. Traditional 60-40 portfolios are not offering much shelter, as rising oil and renewed inflation concerns are pushing bond yields higher at the same time as equities wobble. At the same time, this does not yet resemble outright capitulation. Credit markets, including high yield, have not reached classic stress levels, and there is little evidence of widespread distressed asset sales or forced liquidations. Large asset managers report they remain highly liquid, with substantial dry powder still waiting for clearer dislocations. With the S&P 500 ending roughly flat on the day despite sharp intraday swings, the picture is one of volatile and defensively positioned sentiment, rather than an indiscriminate rush for the exits, setting the stage for the key drivers we will now walk through. The dominant bearish force is the Middle East energy shock and stagflation risk it brings. The effective closure of key shipping routes and damage to regional infrastructure have driven a sharp jump in Brent and WTI, with moves of 6 to 12% in a single session and spot prices pushing above $108. Forecasts for the coming quarter now cluster in the low 100s, and some scenarios see crude reaching around $133 within weeks if disruptions persist. Refined products are even more stressed, with European diesel prices around the equivalent of $200 per barrel and jet fuel costs surging, particularly hurting energy importers. This is feeding directly into inflation and growth expectations. European inflation expectations are rising again, and analysts warn that headline inflation globally could be pushed up by close to 1 percentage point, while shaving a few tenths off growth. Second-round effects are already visible, from raw material costs for Italian construction jumping as much as 50%, to higher fertilizer and gas prices threatening food supply chains. Travel bookings have dropped around 10% globally, with U.S.-bound travel down over 30% year-on-year, while airlines face price target cuts and weaker guidance as fuel bills soar and ticket prices rise. Europe and parts of Asia look most vulnerable in this setup, given their reliance on imported energy and weaker demand conditions than in 2022. By contrast, the United States is relatively insulated as a net energy exporter with a lower energy weight in its inflation basket, although a sharp rise in gasoline prices is still expected to cut roughly $120 billion from household disposable income. Importantly, many observers argue that markets are only pricing the first round of the shock. Potential spillovers into agriculture, manufacturing, and corporate margins are not fully reflected yet. The oil price curve remains steeply downward sloping, which signals an assumption that shortages are temporary, but estimates that it could take months to restore normal flows through the Strait of Hormuz mean that stagflation risk will stay a central macro theme for some time. Linked to the energy shock is a second major headwind: higher for longer policy amid an inflation shock. Rising oil, diesel, and gasoline prices are expected to push headline inflation higher in the coming months, and surveys suggest inflation expectations are creeping up again, especially in Europe. In the United States, strong recent data and elevated long-term Treasury yields are already delaying the timeline for expected Federal Reserve rate cuts. Several commentators note that the Fed is likely to put more weight on controlling inflation than on supporting employment in the near term, which lowers the probability of early easing. Outside the U.S., the policy trade-off is even starker. There is concern that the European Central Bank may feel compelled to hike again to defend its inflation-fighting credibility if energy-driven inflation proves sticky. Some emerging market and smaller developed market central banks may also be pushed into additional tightening to anchor expectations, even as growth momentum softens. Yet monetary policy cannot fix a geopolitical supply shock, which creates the risk of a policy mistake where central banks lean too hard on rates and tip economies toward a harder landing. Bond markets are reflecting that tension through heightened two-way volatility. Long-term developed market yields, particularly in the U.S., face upward pressure from persistent fiscal needs, investment in resilience, and repeated geopolitical shocks, even as investors worry about growth. This combination challenges traditional duration hedges and makes valuations for long-duration growth assets more sensitive to each inflation print and policy signal. At the same time, futures pricing does not yet point to a renewed Fed hiking cycle, and credit spreads remain far from crisis levels, suggesting investors still see a higher-for-longer plateau rather than an aggressive new tightening phase, with a path of energy prices likely to decide which way that balance tilts. The third key bearish driver is private credit stress and liquidity worries. Several large semi-liquid vehicles have faced exceptional redemption requests, with two major funds at Blue Owl seeing withdrawal demands of roughly 22% and 41% of assets, far above the typical 5% quarterly liquidity window. That has forced managers to enforce redemption caps, sell assets, and accept modest share price declines, and Blue Owl's own equity has fallen sharply from its peak as investors reassess the business model. Similar caps at other platforms, including some KKR products, have heightened anxiety about an illusion of liquidity in structures that offer regular dealing in fundamentally illiquid loans. Stress is not confined to retail-oriented funds. Multi-strategy hedge funds, which many investors rely on for steady, low volatility returns, have posted significant losses this month, with some down as much as 4% and erasing year-to-date gains. That drawdown has increased dispersion across managers and raised questions about risk models that struggled with the volatility linked to the Iran conflict. Together with redemption pressures in business development companies exposed to pre-2022 software lending, this points to a more challenging environment for alternative strategies that had previously enjoyed strong inflows. For now, the situation looks like a sector-specific correction rather than a systemic crisis. Asset sales to meet redemptions have reportedly been orderly and near par. Long-term performance of private credit still screens well versus public high yield, and institutional demand for the asset class remains resilient. Redemption caps, while uncomfortable, are standard risk management tools designed to protect remaining investors and slow any run dynamics. Even so, the behavior of leverage providers and the pattern of redemption requests over coming quarters will be important watch points, because a shift from orderly selling to more forced deleveraging could quickly spill over into broader credit and equity risk sentiment. On the bullish side, U.S. and AI earnings resilience continues to provide an important counterweight to the macro gloom. Recent U.S. data show an economy that is still creating jobs, with jobless claims around 200,000 and wage growth for job changers running above 6%, supporting consumer spending. Current expectations put S&P 500 earnings growth at roughly 13%, well above the average of the last decade, and a large share of that uplift is tied to AI-related investment and digital infrastructure. This helps explain why U.S. equities have held up better than many would have expected in the face of repeated energy and geopolitical shocks. The AI theme is central to that resilience narrative. U.S. technology and semiconductor companies with strong exposure to cloud, data centers, and AI workloads remain favored because of their perceived earnings quality and structural growth. Outside the U.S., markets such as South Korea and Taiwan are still seen as long-term beneficiaries of AI-driven export demand, even if they are more exposed to the global cycle in the short run. At the index level, some strategists continue to project year-end S&P 500 levels well above current prices, viewing the recent high single-digit correction as a necessary reset rather than the start of a deep bear market, assuming geopolitical risks can eventually de-escalate. This earnings and growth cushion matters for portfolio construction because it gives investors something tangible to lean on while they navigate elevated volatility. It also helps to explain why smaller, domestically focused U.S. companies have recently outperformed, as markets reward exposure to the relatively insulated U.S. demand story. However, the AI and tech narrative is not bulletproof. Supply chain issues, such as potential shortages of key gases for semiconductors and rising energy costs for power-hungry data centers could slow spending, and there are mounting concerns that any pullback in big tech capital expenditure would introduce a new source of sector volatility. A second supportive driver is the deep liquidity and absence of broad-based distress across major markets. Large asset managers report that they remain highly liquid, with substantial capital still sitting on the sidelines waiting for clearer opportunities in distressed or discounted assets. Despite recent volatility and some widening in spreads, high yield and broader credit markets have not reached levels that would normally signal severe stress. In other words, funding markets are tightening at the margin but are far from seizing up. Within private credit, the headline-grabbing redemption numbers sit alongside evidence of continued gross inflows and orderly asset sales, reinforcing the idea of an adjustment phase rather than an acute crisis. Historically, periods when the S&P 500 trades below its 200-day moving average come with much higher day-to-day volatility, and when the volatility index spikes above the mid-20s, 3-month forward equity returns have on average been stronger than normal, albeit with high drawdown risk. That pattern of volatility without systemic stress is echoed in the equity tape, where the S&P 500 has just broken a 5-week losing streak with a modest weekly gain, even as intraday swings remain large. The practical implication is that the system appears to have some capacity to absorb additional shocks without immediately tipping into a liquidity crisis. That does not eliminate downside risk, especially if the energy shock intensifies or policy error fears grow, but it does suggest that volatility could create more selective dislocations rather than a uniform sell-off. The main caveat is the concern over liquidity mismatches in certain semi-liquid structures and exchange-traded products, where heavy outflows could still force rapid selling. Monitoring how those vehicles behave in the next leg of volatility will be crucial for judging whether this resilience persists. The final bullish driver is that energy and commodity sectors are clear winners from the current backdrop. Major oil companies such as Chevron and Exxon are outperforming as crude prices surge, while energy has taken over as a key leadership sector within equities. Oil field service firms like Baker Hughes, Halliburton, and SLB are positioned to benefit from rebuilding and increased production activity in the Middle East as regional output is gradually restored. In the United States, producers are supported by rising domestic prices as earlier discounts to global benchmarks narrow. This shift in leadership toward energy, staples, and utilities provides a partial cushion for portfolios that already held exposure to these areas, helping to offset weakness in airlines, consumer names, and parts of technology that are more sensitive to higher input costs. However, elevated prices also bring risks. Refinery margins that were very strong are expected to tighten as crude prices catch up and seasonal demand rises, which could increase earnings volatility for downstream players. The oil price curve remains steeply downward sloping, signaling market expectations for lower prices later in the year, so the durability of current sector outperformance will ultimately hinge on how long disruptions last and whether demand destruction starts to materialize. To sum up, today's risk sentiment is best described as volatile and defensively positioned, with a powerful Middle East energy shock and higher-for-longer inflation pressures clashing against resilient U.S. and AI-driven earnings, ample liquidity, and strong energy sector performance. For now, stagflation risk, policy uncertainty, and pockets of stress in private credit are keeping investors cautious, even as the absence of systemic distress and ongoing earnings support prevent a full-scale risk-off capitulation. Key watch points from here are the trajectory of oil and refined product prices, the evolution of inflation expectations and central bank rhetoric, and whether redemption and leverage dynamics and alternatives remain orderly if volatility persists. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.